Welcome to Every Dollar Counts with Josh and Jay, a weekly shot of truth serum for your investments and insurance questions. I am Josh Null, the owner of Gulf Coast Financial Advisors, and I am joined by Mr. Jay Stubbs, Regional Director for First Protective. We are brought to you on the Prime Capital Advisors Podcast Network. Today, Jay and I are going to break down an issue that has become ever more important as our population ages. How do you pay for an extended healthcare event, or otherwise known as long-term care? What are the 6 activities of daily living? What are your options? Have they changed over the past few years? Before we dive into all that stuff, let's have our friends from local band Sloth Racer kick us off. Jay, how you doing today?
Josh, I'm doing pretty good. I like getting back in the saddle early in the morning on a Monday, so it's good to be here in studio with you.
Well, very good. Good to have you. Now, you and I have done a handful of various marketing videos and content on this topic that we're going to talk about today. So I'm pretty excited to see you be able to flex your knowledge muscles in a podcast forum. Before we break down into the individual parts, I'd like you to take the listener through a little bit of your background and what you bring to the table specific for addressing this extended healthcare event cost issue.
I have been in this business, this financial services industry, for 20 years. I have a designation called CLU. That stands for Chartered Life Underwriter. And that means I had to go and take 8 self-study courses on anything and everything insurance and investments. Part of that component was to be an insurance knowledge base on the long-term care insurance marketplace. There's been so many changes. Unfortunately, long-term care is in the news quite a bit because our population is aging.
Right.
Our population is experiencing that heart attack, that cancer scare, or that stroke, or that onset of diabetes, and these people are making it through. They're living through their what used to
a generation or two ago was a death sentence.
It was a death sentence, right? And so what we've got now is an aging population that is surviving. They're outliving their own parents passing away. Their situations were is just really great because medical technology has gotten us to where we are today, but if we're living longer and we need specialized health care, whether it's at home or in an assisted living facility, then we're looking at additional cost during our retirement years. Not only we want to have a good and fulfilling retirement with our significant others and enjoying our children and our grandchildren, but golly, if we throw the cost of taking care or having somebody come by the house and help take care of us because we cannot do certain activities of daily living, then that becomes more of a burden on our overall financial plan. And you as an advisor know this. It could be the death nail to somebody having a long, fruitful, financially filled life is if they have to pay an exorbitant amount of money to an assisted living facility or a nursing home or have somebody come by and take care of them. So to answer your question, I've been doing this now for about 10 years, offering my knowledge in long-term care insurance space. I've been brought into the estate planning councils here along the Gulf Coast to give a talk. I call it the tax efficient healthcare strategies during retirement. And all we're talking about are what are the options that an individual or a married couple can have on the table when they are worried about mitigating that risk.
As an independent advisor, I have somebody like you as a resource to draw upon. So that's a huge help to building my practice in these types of issues. Because I think you and I would both agree with this. There's probably no individual stronger destruction of someone's personal wealth than an extended healthcare event. I mean, the market can go up and down. You can deal with hospital bills, but a lot of times what you have seen in your career, and I've seen in mine, is an extended healthcare event that wasn't planned for is the single greatest thing that destroys wealth.
Absolutely, it is.
Yep. So let me ask you this: you've been in the industry 10 years. What kind of changes have you seen over the last 10 years?
We have seen the progression of the individual standalone long-term care insurance policy a lot of companies have just simply got out of the business. They don't offer that standalone product anymore. And I would draw an analogy to a homeowner's insurance policy or a car insurance policy. A standalone long-term care insurance policy is something that you don't get a benefit from it unless you file a claim. You don't get a homeowner's benefit unless you file a claim after you've had a fire or a flood or some sort of a natural disaster situation. You don't get a car insurance benefit until you have the wreck or you've had a theft or a break-in. With a traditional standalone long-term care, you don't get a benefit until you file the claim. Well, guess what? We talked about it at the top of the show. How many people are living longer, living through the significant medical situation, but need care at home or in a facility? Now they're on claim. Now those companies that were selling these policies for the last 50 years, they've said, we didn't really price that right, did we? We didn't think that people were going to be living this long and keeping these policies. We didn't think that that the cost was going to hammer us financially. So you had a lot of companies get out of the business. Well, when there's opportunity for somebody getting out of the business, there's opportunity for other companies to get in. We've seen now the progression of a traditional life insurance company offer a long-term care rider as an option on their traditional life insurance. So that's another feature that's come around. We've also seen annuity and single premium based products become leveraged. So you can actually say, I've got a leveraged long-term care plan. A lot of different companies out there offer that. So what I've seen over the last 10, 15 years is companies exit, other companies enter, and now there are several options for an individual or a couple to consider when they're looking at mitigating that risk or saying, hey, I don't have any plans for long-term care coverage and I'm interested in it. What are my options?
Well, I want to break that down because I have approached you in the past, and I've been doing this long enough that I've seen in the traditional long-term care space that the sheer number of companies offering a traditional long-term care policy has shrunk dramatically. Is that fair to say?
It's very fair to say.
All right. And now this is probably me just being a fussy advisor, but it also seems like the ones that are left tend to be a little strict on who they let in the door, a little stricter.
Yeah, a little more strict. They don't. You're not gonna. I mean, you've got to answer some pretty lengthy medical questions. They're going to check what we call in the industry. They're going to check your morbidity. Mortality is how long are we going to live. Morbidity is how long is our body going to support us? How long are our hips going to maintain functionality? How about our knees, especially if you were an athlete back in the day? Golly, what about cognitive? That Alzheimer's or ALS kind of situation sits in, and you've got a lot of people who are living a long time but suffering with and battling Alzheimer's.
Well, let's talk about this. So the traditional long-term care policy is still out there. It's still a viable option for some people, right? The downfall of it is it's not really an asset. It's just, like you said earlier, car insurance. If you pay it and use it, you'll be glad you have it. If you pay it and something else takes you out of this world, you may be a little frustrated.
That's right.
But people, I think over the last 5 to 10 years, you've seen a lot of alternative solutions to solving this extended healthcare event issue. Let's break those down individually.
Okay.
Let's start with the first one. Just pay for it yourself.
Yeah, you could self-insure. If you self-insure and you are worried about that amount of money in 15, 20, 25 years from now, what type of cost am I looking at? Well, the Genworth Cost of Care Survey from 2018, the national averages for home health care on a monthly basis was $4,000, about $4,195. So let's just call it $4,000 to have home health care, somebody coming to your house, a skilled nurse, and taking care of you. That costs you about $4,000 a month. Or you could go into an assisted living facility. Again, out of your home in another spot, it's going to cost you about $4,000 a month. And then nursing home, the national averages, we're looking at private room nursing home. You're going to more than double your assisted living cost. That's going to go to about $8,300 a month. So for the individual or the couple who said we're very well off financially, we probably could self-insure that risk. You want to do the math. If we're looking at $4,000 a month or $8,000 a month, let's take that and multiply that times 12. So we're looking at $48,000 annually, or double that, $96,000 annually for one person. So now what's the average length of stay in an assisted living or a nursing home? Statistics tell us it's about 4 years.
Okay.
Any long-term care survey you go and Google out there will say that the average length of time is 4 years. Now we're looking at anywhere from 4 times 48, let's round that up to 50. So we're looking at $200,000 bucket of money, upwards of nearly $500,000 a bucket of money.
Right.
That's how much money an individual would need to have set aside if they want to self-insure and take care of those costs for about 4 years.
Right. And as you and I know, sometimes when people self-insure, they are dedicated and they do set aside a dedicated chunk of money to this, but often not it involves selling something.
Yeah, they've got plenty of maybe real estate holdings,
Right.
or they've got some business interest, or they've got some individual stocks, or maybe a fund, or they may have earmarked an annuity to help offset these costs. That's where they'd sit down with somebody like you and say, we are interested in taking care of that risk. What can we use? You would first evaluate what's your current asset position to determine, does anybody even need to consider leverage or an insurance type of plan in order to take care of it. For that individual or that couple that's got millions of dollars, they might could self-insure, but
Sure.
they also you want to explain to them leverage. Hey, maybe we can take $1 and turn it into $3 to $5 to pay for long-term care.
All right. I want to talk about that. I want to dive into that.
That's leveraging. So we go from self-insure, we talked about it earlier, traditional long-term care policies. You've got that. You've got self-insure, and then you've got leverage. And what we call in the industry is asset-based long-term care. An asset-based policy says, I'm going to take a certain portion of my nest egg or my portfolio, I'm going to reposition it from one pocket to the next. And when I reposition it into a product and I qualify medically, then the underlying insurance company is going to give me anywhere from 3 to 5 times the amount of money I give them. If I never use it for long-term care, I have the option of getting a return of premium. If I never use it for long-term care and I pass away, and my heirs, my children, my grandchildren, if I've never turned on the long-term care switch benefit, then I have a death benefit that comes to my heirs, income tax-free, whatever designated beneficiary. But if I do use it for long-term care, I cannot perform 2 of 6 activities of daily living, or I have a cognitive impairment situation like Alzheimer's, then yes, I will turn on my benefit and it will start to pay those in either a reimbursement or an indemnity type of plan. Indemnity is cash in the hand. I can use the cash for whatever I want. Reimbursement, it's going to be reimbursing the bills that I'm paying from my portfolio. I get that benefit for the purposes of long-term care. And what that means is I don't have to sell that piece of real estate. I don't have to sell that chunk of stock or mutual fund that you're managing for me. And I can let that asset transfer to the next generation, and I can let the insurance company pay the bills.
Well, and I know that you and I deal with the concern people have a lot of times is, oh my gosh, I've waited too late, or I've had some damage to my health. Obviously, the younger and healthier you are, the more leverage you're going to get, right?
Used to be the long-term care insurance discussion started once you retired.
Right.
65, 67, 70 years old. We're now starting to see and have conversations with couples in their early 50s.
Right.
Believe it or not, I was party to a transaction for an asset-based long-term care plan that went into effect for a guy in his mid-40s. He said, you know what, I saw it happen. It's been a family experience. I just want to go ahead and knock this out while I've got the asset. And he's got a plan that's going to be there for him to draw on should he need care tomorrow, or should he need care 20 years from now?
Well, and if you don't mind, I'm going to use the example of the case that you and I knocked out, and we'll use that to wrap up the discussion. We were able to get a 71-year-old female preferred rate on a $100,000 asset-based long-term care policy. She was able to leverage that to almost about $4,000 a month of unlimited benefit, right?
Yeah.
Which just of its own, that doesn't sound too bad of a deal. But she also created a death benefit in there that equaled roughly the amount that she put in. And then what a lot of people don't understand, depending on how you structure the program, that you do have some access to the cash if things go a different direction in your life.
That's right. That's right. You've got access to the cash. It's an equity component. Just as I stated earlier, it's like moving money from one pocket to the next. You've always got access to it. And what a lot of people don't understand is the likelihood of you not being able to perform at least 2 of activity. That's what it takes to qualify for LTC. Is you cannot, your doctor, your primary care physician has said you are not able to perform 2 of 6 activities of daily living. And let me rattle those off real quickly. Think about it in your daily routine. An activity of daily living is getting up. You're able to get up out of bed. One of the first things that you do when you get up out of bed is you take a shower or a bath. That's the second activity of daily living, being able to clean yourself. The third activity of daily living, after you take a shower, Josh, I hope you do this, we get dressed. Getting dressed is an important part of the day. I would think a lot of people want to do that, but that's considered being able to have a third activity. After we get dressed, we head off to the kitchen or head off to the local restaurant or the Cracker Barrel or the whatever, and we get breakfast. We are able to feed ourselves. So those are your 4 mandatory activities of daily living. And then the other 2 that kind of creep in, one is toileting. You got to be able to go to the restroom on your own without assistance. And then you got, if you're out in public, continence, being able to hold your bowels, if you will. That's the 6th activity of daily living. If 2 of 6 cannot be performed, you're deemed to need long-term care coverage or assistance. And let's throw in there the last one, cognitive or Alzheimer's. If you are experiencing cognitive issues, you can also go on claim.
Well, and you and I have both been on earth long enough that we know people in our family, our friends, our clients that have dealt with elder parents or maybe grandparents that have dealt with these things. And as you know, it can be not just these things sound like basic daily activities, right? But those things can slip pretty quick. And then if you're trying to handle helping a parent out or a grandparent out, and you're still trying to work, that can get pretty onerous. So some of these programs have it set up with concierge service where someone can call in.
Yeah,
right?
yeah. They the back end of the policy is important. Being able to have somebody like a son or a daughter or even a grandchild get some assistance from the companies that offer a policy or a solution, that's a big deal. So the back end services, concierge level services, are extremely important, and most of the companies offer them.
Last question. What are the underwriting requirements for these options?
Most of them offer just a telephone interview and a script check and a medical information bureau or an MIB check. If all of that's green light, then you can get some of these leveraged policies or these life insurance policies with a rider.
Perfect. All right, you all know where to find us. If this is an issue that is concerning you, reach out to us. We can help you. Got another show in the can. I want to shout out to Deep Fry Studios. Shout out to Jay Stubbs, always bringing it. Shout out to all y'all that have been with us on this journey, and for those that are joining us on the journey forward. I am Josh Null. He is Jay Stubbs. Got a question for the show? Reach out to us. You'll find a link in the show notes to contact us. Do you like the show? Do me a favor. Please subscribe on the Apple Podcast app or wherever you find your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, if you like the show music, go check out slothracerband.com. That's slothracerband.com, and they're going to take us home now. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Securities offered through Private Client Services, PCS, member FINRA, and SIPC. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented is for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.